Is the Reserve Bank's latest interest rate hike a sudden shock to the system, or is it actually the clearest sign yet that the economic fog is finally lifting? Hi everyone, I'm Debbie Roberts from Property Apprentice. For this week in review, we're looking at what happened in the week ending Friday, 10th of July 2026. And we're unpacking a wave of fresh data that reframes the New Zealand housing market. While the mainstream media headlines are doing their usual dance of panic over the central bank's shift to 2.5%, the underlying reports reveal a massive silver lining for buyers and landlords alike. Today, we're breaking down why peak inflation was just slashed by the Reserve Bank, how the property market is officially fractured into a North versus South Island regional split, and an unexpected type of property that's completely outperforming the rest of the country. Plus, we look at Barfoot and Thompson's brand new data showing a winter supply surge across the Auckland rental market, and Westpac's latest confirmation that household interest costs have dropped for a fifth consecutive quarter. We've got a lot of information to cover today, so let's get into it. Topic number one, from Good Returns on the 9th of July, OCR increase labelled a reduction in monetary stimulus. The Reserve Bank of New Zealand increased the official cash rate by 25 basis points to 2.5% on the 8th of July, characterising the move as a strategic reduction in monetary stimulus. In a surprise twist that caught most bank economists off guard, the Monetary Policy Committee reached this decision by full consensus, a major shift from May's meeting where the tie-breaking vote was required. The RBNZ revealed that inflation likely peaked at 3.9% in the June quarter, notably lower than its previous 4.2% forecast, and expects it to drop to 3.3% this quarter due to easing global oil prices. Fingers crossed that doesn't change with the end of the ceasefire between US and Iran. While the central bank noted that further mild reductions in stimulus might be needed to hit the 2% target midpoint by mid-2027, it explicitly stated that the timing of any future hikes is highly uncertain and will depend on how the incoming data looks. Domestic economic activity slowed slightly in the June quarter, but the RBNZ projects growth to resume immediately this quarter as lower fuel prices actively support a recovery in retail and consumer spending. Officials noted that while domestically driven non-tradable inflation like electricity and rates remain persistent, a weaker demand environment means firms currently have less ability to pass higher costs on to consumers, which will help curb inflation. My thoughts on this are, were you surprised by the increase in the OCR? I was. I thought they'd wait until the next announcement on the 2nd of September so they could see the most recent inflation data, which is due to be reported on the 21st of July, so not long after the announcement where they decided to increase. Even more surprising to me was that they reached a consensus to increase, whereas in the last announcement they were evenly split, keeping it unchanged and increasing, leaving it up to the RBNZ Governor, Dr. Anna Bremen, to cast that deciding vote. I'm loving the transparency we're seeing with these announcements. Instead of leaving us guessing as to their thought process, they're explaining things a lot more clearly. The gist of the announcement is that they believe that inflation's already peaked. It's time to remove some of the stimulus in the economy, which should mean that interest rates will peak sooner and come down again faster as inflation comes back to the target range of 2% sooner than they'd previously projected. Great news all around. Historically, the Reserve Bank has been pretty predictable with taking too long to increase and then leaving interest rates higher, leaving the official cash rate higher for longer instead of being a bit more proactive. They've been a lot more conservative. So it's good to see things changing in the Reserve Bank. All right, topic number two from the New Zealand Advisor on the 8th of July, New Zealand housing market splits in two as the regional gap widens. The latest Kiwi House Price Index reveals that New Zealand's housing market fractured further along regional lines over the June quarter. National residential values slipped 0.4% over the 3 months to the end of June, leaving the average home worth $906,443, which remains 14.8% below its 2022 market peak. In the North Island, Tauranga was the only main centre to record a value increase, while Whangarei and New Plymouth were the only other northern metros to avoid average declines. Conversely, property values rose almost everywhere south of Greymouth, with the sole exception of Dunedin. Christchurch led major metropolitan performance with a 0.9% lift, outpacing subdued conditions in Auckland, which dropped 0.7%, and Wellington, which fell 1%. Resilient local economies, comparatively affordable pricing structures, and a steadier supply-demand balance continue to support Canterbury and Southland. While the northern markets face an oversupply of listings in some areas and softer economic sentiment, first home buyers remain highly active across most regions, calmly leveraging elevated stock levels with zero urgency to settle for less than what they want. My thoughts on this are that the regional divergence is exactly why we always tell our clients to stop treating New Zealand as one single property market. It's a collection of micro markets, and the national averages completely miss the real opportunities. While Auckland and Wellington are drifting sideways, the South Island is thriving. Does that mean that the South Island has better opportunities than Auckland and Wellington? Not necessarily. Christchurch is up nearly 1%, and values are climbing almost everywhere down south because of more robust local economies and more affordable pricing. But what's brilliant here is that first home buyers and experienced investors aren't panicking at all. They're treating these elevated stock levels like a giant buffet. They're taking their time and negotiating great deals. Use the current market softness to buy sooner rather than later, as long as you're buying the right sort of property for your financial position and with your long-term goals in mind. But if you do that now, while your competition is still sitting on the sidelines waiting for more certainty in the market, you will reap the rewards. Topic number 3 from businesstimes.com on the 8th of July. Flood risk doesn't matter as bargain houses tempt New Zealand buyers. Properties facing the highest flood risk are outperforming New Zealand's broader housing market, gaining 26.1% in value since January 2020, compared with 19.8% for homes with no risk exposure. A new report by property consultancy Cotality reveals that cost-conscious consumers are actively chasing lower prices and accepting known weather exposures in exchange for significant upfront discounts. In Auckland, for example, purchasing a home in a flood-susceptible zone can offer an upfront discount of as much as $100,000, with these impacted areas outgrowing unaffected zones by 18.4% to 13% since 2020. Impacted properties in Hawke's Bay similarly outperform surrounding areas by as much as 5 percentage points, even after Cyclone Gabriel caused an estimated $14.5 billion in economic damage to the region. Despite a prolonged downturn cutting New Zealand's median house price by 16% from its 2021 peak, homes remain expensive enough that buyers are potentially willing to accept some climate risks to get onto the property ladder. Cotality issued a strong warning regarding insurance implications, noting that providers are rapidly refining property-by-property asset risk profiling. Because insurance availability adds as the de facto pricing mechanism and serves as a non-negotiable prerequisite for mortgage lending, any future retreat by insurers will completely freeze a property's loan availability and liquidity. My thoughts on this are, when you treat property as a business, math beats emotion every single time. This data proves that cost-conscious buyers are completely ignoring the media's scare tactics, because an upfront discount of about $100,000 in Auckland could be simply too powerful for some buyers to pass up. However, you need to look at this with a strict reality check. Because insurance is a non-negotiable prerequisite for getting a mortgage, your absolute first step when evaluating a property that sits in a flood-susceptible zone must be verifying your ability to get insurance cover during that due diligence period. Also, It's important to note that not all properties that are zoned as flood susceptible are actually flood prone. There's multiple examples out there of where the local council's risk mapping have been seen as being overly cautious. Likewise, some properties that are not zoned as flood susceptible have had flood issues in the recent past. So do your homework regardless of what the flood zone is. If the property is insurable and you do your own homework on the potential risk and you're comfortable with that risk, this could be a really good opportunity for you. Just make sure that you run the numbers with total discipline and never buy blindly. But very interesting to see that there's clearly competition from buyers for this type of property, as demand obviously exceeds supply in this sector, which is why we're seeing these properties increasing at a faster rate than properties that don't have these issues. So if you're getting value out of this podcast, please open up Apple Podcasts or Spotify app right now and hit that follow button. It's the number one way to help us help more first-time buyers and property investors gain access to quality content. And if you want to learn more about investing, join me at one of our free online events called How to Succeed with Property Investing, where I'll focus entirely on helping you build the right mindset and strategy for your financial success. As a financial advisor and experienced investor, I'll help you to navigate the current market with more confidence and make smarter decisions. We're live, online, and independent. We don't sell property at Property Apprentice. Go to propertyapprentice.co.nz to register for the next free event. Topic number 4 from Stuff on the 8th of July, Auckland rental market cools as winter slows tenant activity. Barfoot and Thompson's latest data reveals that Auckland's rental market experienced a seasonal slowdown in June, with inquiries falling 10.9% and applications dropping 6.1% compared to May. The total number of properties let also declined 6.9% as the region transitioned off its high summer peaks and entered the typically quiet winter period. Despite the monthly winter cooling, underlying tenant engagement remains much stronger than last year, with annual inquiries up 18%, applications up 17.6%, and viewing attendance up 17.9% year on year. Total available rental stock across the agency's portfolio jumped 10.9% over the month to finish June with 772 available properties, vastly expanding choices for tenants. Average weekly rents across Auckland remained incredibly stable at $698.17, barely moving from May's average of $697.82 and up by a minor 0.9% from $691.98 a year earlier. Rental pricing across the super city remains highly localised, ranging from an entry baseline of $578.48 in apartment-heavy central Auckland to a high of $754.12 in Pakuranga and Howick. Property management officials stressed that homes offering heating and comfort features that go well beyond minimum healthy home standards are currently generating the strongest interest from tenants. My thoughts on this are, if you glance at a headline saying rental inquiries dropped nearly 11% last month, it's easy to mistake it for structural weakness, but this was actually a completely normal winter reset. Happens every year. People don't like moving house when it's cold and raining. But look at the underlying annual metrics. Inquiries and viewing numbers are up nearly 18% compared to this time last year, meaning tenant demand is fundamentally solid and no doubt at least partly to do with the improving economy. Remember, when things are really tight financially, people tend to move back home, with mum and dad or have more flatmates to help cover the cost of housing. So this could be a sign of the times moving where people are happy to move out on their own again. What has shifted is the amount of choice. Available listings jumped by almost 11%, which takes the frantic pressure off tenants and lets them shop around. Success in this balanced market requires presentation discipline. If you want top-tier tenants who stay long-term, Ensure your property is competitively priced and goes beyond the basic Healthy Homes minimum standards by offering real winter comfort and high quality heating. You're competing with more new builds now, so you can't afford to slack off and price your investment out of the market for rent. Topic number 5 from Good Returns on the 6th of July, 5th drop in amount households spend on interest. Westpac's latest household finances chart pack reveals that household spending on interest payments has successfully declined for a 5th consecutive quarter. While short-term mortgage rates have faced minor upward pressure, long-term wholesale swap rates fell by 15 basis points, pushing major banks' 3-year fixed rates down to between 5.19% and 5.29%. Westpac senior economist Satish Ranchod notes that 90% of New Zealand's mortgage debt remains safely locked into fixed terms, completely insulating households from sudden interest cost spikes over the next few months. On the wealth side, the total value of household financial assets rose 3.3% over the past year, with Cotality data showing $234 billion held in superannuation and KiwiSaver, alongside $342 billion in commercial real estate. Conversely, the residential real estate market remains beautifully flat and essentially unchanged since 2023, with $1.67 trillion currently tied up across 1.73 million Kiwi homes. Average household disposable income levels climbed 3.8% in the year to March, heavily supported by a massive 14% in entrepreneurial and agricultural earnings. My thoughts on this are that this Westpac data provides evidence that despite the ongoing cost of living conversation, household interest costs have dropped for a 5th consecutive quarter and disposable incomes have climbed by 3.8%. And that, people, is good for our economy. Because an incredible 90% of New Zealand's mortgage debt is fixed, everyday families have the ability to protect themselves against short-term mortgage interest rate fluctuations. Meanwhile, our residential market is holding at a flat, stable baseline. For anyone focused on building long-term wealth, this is the ultimate silver lining. Rising incomes and affordable housing is your chance to get your foot on the ladder or to expand your rental portfolio with purchasing decisions based on the fundamentals, not based on the fear of missing out, allowing for time in the market to do the heavy lifting for your financial freedom. I want to hear from you in the comments. With retail banks quietly cutting some short-term rates even as the Reserve Bank prepares to hike further, are you opting for the safety of a longer term, or are you playing the short game with a 1-year fix? Let me know your thoughts below. If this breakdown gave you the clarity you need to navigate your mortgage and property plans this week, please hit that subscribe button and give this video a like. Tell your friends about it too. Get them to subscribe and listen as well. And if you want to discover how to build a highly resilient, cash-flowing property portfolio that can comfortably withstand any interest rate cycle without the guesswork, join me at our next online event called How to Succeed with Property Investing. It's free and you can secure your spot right now by going to propertyapprentice.co.nz. Thanks for listening. I'll see you in the next episode.